Why do assets lose value on paper even when they still work? Welcome to depreciation. Depreciation spreads the cost of a long-term asset over its useful life. It matches cost to the number of years that an asset will benefit a firm. Straight-line depreciation charges the same amount each year. The formula is historic cost minus residual value divided by useful life. Historic cost is the amount paid to buy the asset originally, whilst residual value is the sum of money a firm expects to raise from selling the asset at the end of its life, e.g. its scrap value. So let's look at an example. Let's suppose a firm has an asset costing £50,000 with a residual value of £5,000 and an expected useful life of 5 years. Using our formula, we subtract the residual value of £5,000 from the historic cost of £50,000, which gives us £45,000. We next divide this by 5 years, the useful life of the asset, to arrive at an annual depreciation value of £9,000. If we then deduct the historic cost of the asset by the annual depreciation of £9,000 a year, we are left with the following. By the end of year 1, the book value of the asset is £41,000. We then continue until we reach the end of year 5 with a figure of £5,000, the residual. If we go on to plot this data on a graph, book value drops in a straight line from £50,000 at year 0 to £5,000 at year 5. Okay, so let's look at the benefits of depreciation. It firstly means that the asset's true value is displayed, which minimizes the risk of window dressing of the accounts. It also helps a business to reflect the wear and tear of an asset and avoid a business's assets being overvalued. The formula is also simple to use and easy to understand. Moving across to the disadvantages, and the value doesn't reflect an asset's full usage or wear, it ignores rising maintenance costs as an asset gets older, and in reality an asset like a car depreciates far more in its early years than it does towards the end of its life. The residual value figure is also only a guess at best. Right, let's finish as usual with a quick look at our exam tips. AO1 Define and give the formula. AO2 What are the implications for the business you are studying? AO3 Explain what the result means for profit and the asset's book value. AO4 Evaluate. It depends on asset type, usage pattern, and accuracy of useful life and residual value. Okay, I think that's us finished. Remember though to pay a visit to teachingbusiness.org.uk to discover more great resources to help with your teaching and learning of business.